Well, we just got some data. Boom! That's pretty dang exciting, and it makes me want to say,
in the lead.
Yes, absolutely. Because guess what? We just got the JOLTS data release, and listen to this. We were expecting 10.5 million. The prior read was 10.824. They revised the prior read from 10.824 to 10.563. That is jobs openings, right? The JOLTS is the job openings and labor turnover survey. So in other words, they went from 10.8 to 10.5 in the last reading. Well, now the survey was projecting 10.5 for the current reading. It actually came in at 9.931. Really good beat. We watched that live together with course member live stream. Phenomenal. On top of that, we also got factory order data. A little bit weak here. We got the prior factory order data coming in at negative 1.6. That was revised down even more to 2.1. The current survey was negative 0.5%, and we got negative 0.7. So worse than expected factory orders. So you're getting a softening labor market now and a softening factory order section. This should be a big bat signal to the Fed. Stop tightening so much, you tight wads. Anyway, then we got a durable good orders release that was expected to come in at negative 1%. It did. Durable good orders, with the exception of transportation, came in at negative 1%, negative 0.1%, that is, versus the expectation of 0. So pretty much everything came in weaker. Remember what durables are? They're like home appliances. You know, think like big things like machinery or cars or washing machines, appliances, CNC machines, whatever, right? So it's kind of like the components that help you do stuff compared to factory orders being like, all right, we have the components, what are we making with them, right? In this case, all of the data came in soft. This is very important data for the Federal Reserve, the JOLTS data report, because it tells us this whole idea of a wage price spiral is a myth. And the Fed needs to relax because all of the leading indicators are pointing to disinflation. Yet the Fed continues to hike as if we're experiencing reinflation, and we're not. When we look at earnings calls across the board, we are not seeing the indicators of inflation still here. The only place maybe we're seeing it would be in aerospace and, in a weird way, pet food. But beyond that, we're just not. Given the fact of the availability of supply of laborers willing to work for Uber and Lyft, we have plenty of people willing to work. You remember I've said many times before, Cloudflare received over 400,000 applications for somewhere around 1,300 jobs, as they talked about in their earnings call. McDonald's is expected to lay off a bunch of corporate workers this week, despite the fact that their franchise model is actually extremely profitable. They're feeling the squeeze as well. When we went through the earnings calls of other companies this week as well, we saw the same thing, no indications of a wage price spiral. Darden is no longer able to raise prices like they previously were, although everybody was talking about how, the restaurant industry continues to raise prices. Not Darden anymore. They've raised prices, yes, and prices are higher than they used to be, but the rate of increase has slowed. Canadian Solar sees substantial deflation ahead. What do we got? Dave & Buster's talking about both disinflation in labor and goods. Look at that. I'm going to start with labor inflation. We're seeing some relief there. I think when you look at hourly wages sequentially, they're relatively flat, which means quarter over quarter. I feel like we've got that stabilized. And with commodities, we've actually seen a nice decline. This is Dave & Buster's. And it's not just them. It's multiple companies. Starbucks, Chipotle. All the companies are almost in alignment. I read earnings calls almost daily. And there just seems to be this extreme alignment on there is no inflation anymore. Yes, prices have gone up, but they're not continuing to run away, which is great because it's a big indicator to the Fed to do what? To pause. Follow the lead of the Bank of Australia and pause. Let's talk about the Bank of Australia now. And remember, we've got European inflation expectations as well that came in softer than expected. But for now, Australian Central Bank and what it means for America. Let's take a look at the first pause of the banking crisis. So one of the first and major pauses of the banking crisis is in, the particular institution that paused is actually one that led the United States on rate hikes. That's a sign that maybe the United States will soon follow this particular bank. So think about it. They hiked, then the US hiked. Now they've paused. And what could they possibly cite, and how could their information be similar to what we're experiencing in the United States? Well, after you read this statement with me, you'll see, wow, it's surprisingly similar. Let's take a look at it right here. This is the Bank of Australia. The board decided to leave the cash rate target unchanged today at 3.6%. In other words, pause. The big old pause is in at Australia. And remember, they started hiking before us. That's important. All right, the board took the decision to hold interest rates steady this month and provide additional time to assess the impact of the increase in interest rates to date and the economic outlook. Global inflation, they say, remains high. And this is actually something that we're wanting to pay attention to as well in the United States is, wait a minute, if inflation is high, why would you potentially pause? Well, they give us some reasons, and in my opinion, it actually might give some indications to the United States. Take a look at this. Global inflation remains high. In headline terms, it is moderating, although service price inflation remains high in many economies. Service price inflation is, of course, that third type of inflation that we're facing in the United States as well. Phase 1 being goods and disinflation, phase 2 being housing services disinflation, and then phase 3 being all other services, specifically healthcare, retail, hospitality, and otherwise. And this remains high in many economies. The outlook for the global economy remains subdued, with below average growth expected this year and next. The recent banking system problems in the US and Switzerland have resulted in volatility in the financial market and a reassessment of outlooks for global interest rates. These problems are expected to lead to tighter financial conditions, which would be an additional headwind for the global economy. So they, like us, are recognizing this potential for tighter financial conditions, leading to basically the equivalent of more hikes. So that's potentially why they're taking a pause. Now listen to this on CPI and inflation. Well, CPI being inflation. A range of information, including monthly CPI indicators, suggests that inflation has peaked in Australia. Now, this is good because we would imagine that the Federal Reserve and Jerome Powell might say something convincingly like this at some point in the near future as well. Imagine if Jerome Powell came out in the next meeting in May and said, inflation's peaked, we're confident of it. It would really, if they didn't pause then, lead markets to start pricing in. Oh, they're setting up for a pause. And be quite bullish because remember, nobody really expects the Fed in this cycle to actually cut rates until inflation is conquered. That's a big deal. And I think a lot of folks forget that the Fed isn't here to cut at the sign of potentially a recession. If anything, they are engineering this recession in order to make sure inflation has been convincingly conquered. Multiple different reports, whether it's JP Morgan, Morgan Stanley, whether they're bears or bulls, suggest it's clear. The Fed is not cutting anytime soon until inflation is conquered. But Australia actually gives us hope that, wait a minute, maybe that peak is closer than we think, or that peak is already well behind us to the point where central banks can start reacting. And so that makes this such a unique occurrence where the Bank of Australia, which again led the rate increase cycle, is now pausing. Goods price inflation is expected to moderate over the months ahead due to global developments and softer demand in Australia. Meanwhile, rents are increasing at a faster pace in some years, and vacancy rates are low. The price of utilities is rising, and the central bank forecast for inflation is expected to decline this year and next to around 3% by mid-25. Medium-term inflation expectations remain anchored, and it's important this remains the case. This is also quite interesting because what you have is the central banks basically saying in Australia, hey, look, we want to get to about a 3% inflation target, and we're willing to wait until 2025 for that to happen. Now, that's pretty incredible. It's almost as incredible as the paid promotion here to get 12 free stocks by going to metkevin.com/a free, link down below. But think about that for a moment. If The Bank of Australia is saying, look, we're going to pause. We realize inflation is still high, but we're at peak. Let's now just let our rate hikes actually function. And we're okay with not only a 3% inflation target, but we're willing to wait another 2.25 years to get to 3%. They said it'll be 3% by mid-25 is 2.25 years is how long they're willing to wait to not get to 2%, but to get to 3%. And this could be something that our Federal Reserve does as well. All they have to do is say, yeah, we're okay with an average of 2% by mid-2025. Kind of interesting. Let's keep going with the statement from the Royal Bank of Australia. Oh, there we go. Fix that. All right. So, growth in the Australian economy has slowed, with growth over the next couple of years expected to be below trend. That's been Jerome Powell's goal as well, to push us into an environment of below trend growth. There is further evidence that the combination of higher interest rates, cost of living pressures, and the decline in housing prices is leading a substantial slowing in household spending. While some households have substantial savings buffers, others are experiencing a painful squeeze in their finances. This is usually the difference between poor income households and wealthier households. The unemployment rate is near a 50-year low, and unemployment is also low. Many firms continue to experience difficulty hiring workers, although some report an easing in labor shortages and the number of vacancies has declined. So, very similar again to the United States. Very low unemployment, probably also our 50-year low in unemployment, and a difficulty to hire new workers, but things are starting to loosen. And those are the conditions that led Australia to pause. It's starting to sound very similar to the United States. Right now, we're sitting at about a 50-50 chance of pausing. I do think there'll be a psychological benefit to the Federal Reserve to getting us to 5%. So I wouldn't be surprised if there's one more hike in the pipeline and then a pause, especially since right now we're at 4.75, and I think hearing, okay, Fed lower bound rate is 5% is a good psychological way to show the Fed is really serious about inflation. But beyond that, I think further hikes are less certain, especially since now you've got the Bank of Australia saying wage growth, even though it's growing, is actually consistent with their inflation target. And their goal is to return to a 2 to 3% inflation regime. The path to a soft landing remains a narrow one, but they're taking the steps to get through a soft landing by pausing. Now, I personally think that's very fascinating. I want to look now in reaction to this at the Goldman Sachs Financial Conditions Index, and maybe what we can do as well is look at inflation break-evens. Because generally what we want to see are that financial conditions are at least somewhat elevated. They don't necessarily have to be as high as previously. And we want to see that the 5-year break-even inflation rate is staying stable and not skyrocketing. After those OPEC production cuts yesterday, we did see the 5-year break-even tick up. So it'd be good to see how it's moving today. I have both of those charts, so let's pull those up and then evaluate those alongside what we just heard from the Bank of Australia. So the first chart is right here. Right here. There we go. This is the first chart. This is the 5-year break-even inflation rate. You can see we had a nice little surge here after, an oil price cut. Oil production cut, but it really shrunk. Yesterday, this surge was actually a lot higher. I would go as far as saying we were up to about 2.6 yesterday on the 5-year break-even. So we've really dropped down some of the severity of those oil production cuts here in terms of inflation expectations. So I would say that's actually very good news. I don't think it's so terrible that we remain potentially along this sort of average right here, which would be about the last 9-month average. That's probably not horrible. I do think before we get any kind of cuts, we need to see this level down to about 1.6%. So it's going to be a moment before we actually get that down. And then here we have the Goldman Sachs Financial Conditions Index. This tightened substantially during the banking crisis as it was starting, but financial conditions actually quickly loosened again And so right now, we're sitting at some of the lower levels that we've been in since December and about the end of January. So Goldman Sachs financial conditions lowering slightly. This all comes at the same time as you've got the 10-year Treasury yield right now sitting at 3.46%. The 2-year, just for comparison, the 2-year Treasury yield right now is sitting at just about 4.01%. So you've still got that inversion of about 55 basis points between the 2 and the 10-year at the moment. The 3-month, which is another pretty common one, is sitting at 4.9, which is pretty widely inverted. 4.9 to 3.46 puts you at almost a 1.4 percentage point inversion, pretty substantial between the two. And if we look at that historically, I know we've had some recent re-steepening of the curves, and often people like to say that as the curve re-steepens, that's when you know a recession is imminent. But so far, it doesn't actually seem like that's happening to the 3-month 10-year. That did happen with the 5s and the 10s. You got some re-steepening, the 2s and the 10s, and for those two. But you're not seeing any of that at the Fed's preferred measure of recession, which is actually this one right here. This is what your 3-month 10-year looks like. That's the math that I just sort of mental math calculated. And look how steep this inversion has gotten. Here, I'll hide myself for a second so you can see this a little bit more broadly. There you go. Look how steep that is. 144 basis points, 1.44% here of inversion. You've had some volatility, but I think the trend is exceptionally clear here. When we draw a line, not a curved line, there we go. When we draw sort of the trend line here, it suggests we're still substantially inverting relative to seeing any kind of steepening of that curve. Now again, usually the steepening is the painful part, unless of course this is just a measure of, hey, you know, we still expect high, and this is the only counter argument against the inversion of the yield curve. Hey, well, the yield curve is as inverted as it is because, well, obviously inflation's going to be high for the next few months, so we're going to demand a higher yield now than we will 10 years from now. You're really taking the polar extremes, right? The near term and the long term, basically purely liquid and almost purely illiquid. Although treasuries are relatively liquid, it from a time perspective, it makes a lot of sense that you could just hold the 3-month to maturity and it's basically like cash. We do a lot of that with House Hack, a lot of rolling 3 months. So that's pretty remarkable. Now, not only is that remarkable, but it's worth keeping an eye on what the Bank of Australia is doing and other central banks are doing, because it really potentially can give us a leading indicator, especially since the Bank of Australia led the Fed. So with that said, remember, Bank of Australia, leading indicator, and they just paused. Their arguments for pausing is let the lagging effects hit. We don't have a wage price spiral, wages are growing as expected, we're slightly below trend growth, and maybe we can actually thread the needle of a soft landing. I should say very few people actually think that's possible to stick a soft landing, but there is a lot of hope. But always remember, hope is not an investing strategy. Instead, do your own fundamental analysis or join us in the fundamental live streams, link below.